Hello and welcome to my Q4 quarterly update for my eToro Rubymza portfolio. If we haven't met before, I'm Heloise Greeff and I've been publicly managing this portfolio since 2016. Before we get started, please be aware of the notice below, and without further ado, let's get going. If you've been to one of these before, you'll know the format. They've been the same for many years now. If not, we'll start with a brief background of myself, go over the investment strategy, have a little look at the portfolio and the positioning before discussing the market review and the outlook. I'm Dr. Heloise Greeff. I'm a full-time investor and I focus on long-term system-driven investing. I have been active on eToro since 2016 and I've been a full-time pro investor since 2022, and I'm followed by more than 250,000 people on eToro. I'm originally from South Africa and I came to the UK, to Oxford specifically, to study as a Rhodes Scholar. I did biomedical engineering followed by a PhD in machine learning and my MBA. I've consulted for a number of startups around the world and I still sit on the board of a couple of health tech startups. So my understanding and knowledge of technology runs very deep, and specifically of data and AI in different geographies. And that's really what I leverage as part of both the way I manage the portfolio, but also the network that I tap into in order to form my decision making as part of the portfolio. So at a high level, I built a portfolio for myself. If you've heard my story, you know that I was an investor on eToro for a long time before they asked me to make the portfolio public and join the Popular Investor Program. And so what that meant is I built a portfolio for an investor like myself, somebody who wants to have medium risk, who has a long time horizon, and who really uses data and fundamentals as an input for the decision making. And that has been wildly successful, with attracting thousands and thousands of copiers from around the world over many years now. And I think that's just because I built something that is authentic, that is for myself, and that I manage my own money in predominantly as a full-time investor now. So the investment strategy can be broken down into two main layers. The first layer is what I call the basics. That consists of a focus on growth, so really looking at long-term compounded growth. That means rebalancing, reinvesting profits, and really taking that long-term view to ensure that the portfolio is consistently growing. The second arm is around decision and risk management. As I mentioned, I want to have a medium risk portfolio. So even though the destination might still be the same as another portfolio, we want the ride to be smooth as well. So we don't want to have wild volatility and massive drawdowns. And so big focus goes into risk management to reduce the overall volatility in the process. And then the third arm really focuses on using strong fundamentals to ensure that we understand what's going on in current economic environment, how that not only influences the portfolio in its current position, but also how do we position the portfolio for the next 6 months, 12 months, 2 years, 5 years, 10 years, to ensure that we get that growth that we really want. The second layer of my investment strategy is what I call uniquely me. For me, that means really utilizing my background in AI and machine learning. So not only investing in those sectors, but also using proprietary machine learning algorithms that I have developed over the last decade in order to make the investment process smoother, more efficient, and get better returns. So that is me using my strength, my skill set. The second part of this layer comes around how do we manage fees. So this really means utilizing technology, using something like eToro to build a public platform where there is very low or limited fees, as well as not passing on the management fee of the portfolio onto the end copier, because as you know, eToro doesn't charge any additional fee on that. And so I believe by using technology, leveraging it in that way, having access to an actively managed fund in this way becomes much more accessible for more and more people. And the third and final part of that, which I've been quoted in Bloomberg for, and this is really using the hive mind, the mega trend, again, utilizing technology to ensure that I can get those optimal returns in understanding how long-term focus and high growth happens in development trends. So that means doing sentiment analysis, doing data extraction, many different tools that I use in order to make sure that we're using all of the data available today to ensure that the portfolio is optimized for its returns. So what does that mean for a copier? Why are thousands of people copying me, not only on an ad hoc basis, but also I have an average copier duration of 1,192 days, so over 3 years. It's a long-term relationship that I build with my copiers. And looking at the way people use the portfolio has been really interesting, because even though it's a medium risk portfolio, I have found that across the board, different copiers with different risk appetite use the portfolio in many different ways. So there is a big cluster of low risk investors who are seeking safe and steady returns. That's what this portfolio will give you. So they often have 80 to 100% exposure to my portfolio, and maybe combining that with some ETFs. There are some medium risk seeking copiers who want the balance between risk and reward. They usually have about 60% of their portfolio exposed to my copy position, and they then combine that with either other popular investors or individual stocks. And then finally, quite interestingly, but actually not that surprising, is I have a number of high risk investors who, although they seek volatility for greater returns, with the rotation in crypto, many of them have now converted some of their returns into a copy position with me, and that's usually between 10 and 30, some now up to 50%, and that really forms the core part of their wealth preservation or the capital preservation aspect of their high risk portfolio. So it's a really versatile portfolio, because it's given above market returns with very sort of low returns, minimal drawdown and volatility. So it's been really remarkable to see how investors have used that across the board as part of their investment strategies. If we then deep dive into the portfolio risk and return, as I said, I aim to keep a medium risk score on eToro. That is a number out of 10, to just give you an idea of the scale. I usually aim to keep my risk score between 3 and 4. Currently, with market volatility, it's been 4 for the last couple of months. And the portfolio volatility is 2.7%. So you can see it's really very balanced growth with strong risk management, which means you get those returns, above market returns, without, the emotional turmoil that comes with the volatility of it. And it's proven itself over nearly 10 years now. I'm going into my 10th year on eToro. Last year in 2025, we delivered 29.71%, and there's been consistent risk adjusted returns year after year in the portfolio. And that's really been the aim from the beginning for myself and later as copiers joined, is to just have a focus on those core returns, and not have any, unexpected events affect the portfolio. So if we have a look at how the portfolio performed in 2025 in comparison with other benchmarks, as I said, the portfolio delivered 29.7%. That outperformed the MSCI World Index, which delivered 21%. The broader European stocks, which did 17%, which for many reasons did better than the US benchmark. And the S&P 500, which is the US equivalent, did 16%. So overall, a really, really strong return for investors, but not overexposing them to any additional risk. And that is really the key takeaway and aim of this portfolio. If we then look at the portfolio positioning, I have a very strong exposure to the technology sector. That's always been my bread and butter, given my deep understanding and development, as well as having some machine learning patents of my time at Oxford. They say just invest in what you understand. So for me, it's technology. And that has really served the portfolio well over the last 10 years. But technology also filters into many other sectors, and we have included financials. They've also done really well in the volatile markets in the last 2-3 years. And then a couple of defensive positions, as well as some bonds at the moment, to ensure that we are ready for any changes or swings going into 2026. Compared to the S&P, our exposure is much more towards technology. We also have basic materials, and then somewhat underweighted in the financial services, and very little exposure to utilities, consumer defensives, and healthcare. And I think that's one of the reasons the portfolio has been able to outperform the S&P 500 over the last year in 2025. And that's just because rather than mimicking the index, sector by sector, we've been able to be a lot more selective over taking positions in sectors and geographies that we had strong belief would outperform, rather than taking a broad basket approach. And that has been the success of this portfolio over its lifespan. If we then take a bird's eye view in terms of what happened in the market in this last year, in 2025, there was a strong macro backdrop, and we saw that resilience more than euphoria paid off for the investor. Growth was slower but positive in the US. Europe was weak, and we saw China stabilizing but still structurally slower than other markets. Inflation continued to be a key theme in 2025, and although the inflation has fallen from its previous peaks, it's still been more sticky than many investors expected, especially in services. And the same for interest rates. They have stayed higher for a lot longer than some investors expected. Our portfolio was prepared for that because back in 2022, 2023, I was talking about the L-shaped recovery, and that's just because we had anticipated that rates would stay a little bit higher for a lot longer. So overall, 2025 rewarded earnings durability more than it did macro guessing. And so It wasn't about what markets did in terms of growth and inflation, which really surprised the investor, but it was more the fact of how few or how little things broke down this last year. In terms of equity markets, we saw a really narrow leadership, and a wide dispersion. And US equities outperformed most of the other regions again, and returns were really concentrated. There was a really small group of mega caps, particularly in the Mag 7, that drove those in indexes, especially the S&P 500, for its performance. And there was a big tail of stocks that did very little or nothing, or even went backwards despite the good headlines. And so the important thing for copiers and investors to remember is that index returns can often overstate how easy it was to make money. And 2025 really rotated back to strategic stock picking. And the third theme was around style performance. 2025 was really the year where quality beat speculation. Companies with lower pricing power, strong balance sheets, and clear cash generation were winners in this year. And the losers were those which were highly leveraged. They had pre-profit growth and a lot of hype-driven narratives without early earnings following through. And so markets this year, 2025, consistently punished any impatience for the investor. And then finally, the fourth theme was AI. I mean, we've been talking about it for multiple years now, but I think in 2025, we went from narrative to seeing more numbers. And although it's still very, very early days, there are some early AI beneficiaries that has moved from promise to revenue evidence. And that's really strong in terms of being able to differentiate whether this is just a passing bubble, whether it's overhyped, and where the real value lies for investors. The secondary beneficiaries really lagged unless their monetization was really clear. And this is where we saw that the hype was somewhat over and the valuations really began to matter again. So even though the AI exposure helped the portfolio and any investors this year, AI storytelling alone didn't really, carry over on its own. And that really, comes back to this behavioral lesson for investors, where we saw that frequently switching really hurt investors, and trying to change or chase the quarterly winners really just led to underperformance. And our portfolio massively benefited from staying invested in high quality businesses that were selected for their, income generation abilities. Their story made sense, and that really paid off in terms of testing discipline more than being a forecasting contest in 2025. So we've been talking about the FANG for a long time, but one of the key things that emerged in 2025, and I think will continue going into 2026, is the thematic immersion of what we call FANG 2.0. So this is referring to fuel, so understanding how not only sectors like AI, but also geographies become more energy independent. And we've seen a couple of key companies emerge in those sectors that I'm watching quite closely. Also, with the geopolitical instability, the aerospace and defense sectors have become a really strong play. We've benefited from that through Rolls-Royce. We had Palantir in the portfolio for a bit through the year, and so those defensive plays around the geopolitical arena did particularly well this year, especially if they had specific regional exposure where they could maintain strong tech leadership. Agriculture is also emerging along a bit with fuel, but it's that conversation around sectors or regions becoming more independent, and that not only includes energy but also extends to food supply and sustainable production. Again, there is a number of early companies that are emerging that I am keeping quite a close eye on. Sort of connected to the fuel question, but more specifically nuclear, is it's starting a couple of key developments in that sector means that the future power requirements is demanding more clean energy solutions, and a couple of key breakthroughs in that sector has led to more momentum. And so again, one that we are closely watching. And then finally, one that we have been a great beneficiary of since about June last year is gold and metals. If you have missed the rally about gold and metal, it's just that usually when there's uncertainty or volatility in markets, there's often a rotation to hard assets. And gold at first was a key beneficiary of that. I introduced that into the portfolio. We benefited from the growth in that, and then made a very strategic bet on silver, which has been rallying. I just closed a couple of positions at 80, 90, 100% returns. And so they offered a really strong hedge against this economic instability and inflation that we've been seeing. And we are keeping a close eye on them in the portfolio, but I don't expect this to change rapidly going into 2026. We expect that they still have some runway going into the new year. So if we then look forward into 2026, there are sort of 4 key themes that I believe will be really important for investors. Number 1 is the starting point. The starting point really matters because we enter 2026 with elevated valuations. They're not extreme, but they are somewhat elevated. And although we expect interest rates to drift lower, it will be a slow drift. And so it means that growth is a bit uneven. I'm not expecting it to collapse in 2026, but it will be uneven. And so that means it's not an entirely cheap market going into 2026, but it's also not a very fragile market. It just means that investors have to be very aware and seek value very strategically in a market like this. Basically, there are a lot of opportunities, but you have to look for them strategically. The second theme is around the base case that we would anticipate for 2026. In terms of returns, we would expect them to be more muted than 2024 and 2025. I expect the base case headlines to be more volatile than people expect. Nothing, extreme, still manageable, but we are strapping in for a more volatile base case. And then the market will be broader in terms of leadership, so we'll still have to be very selective. So 2026 for the portfolio and copiers will be really about compounding the strong growth that we have been able to manifest over the last couple of years, and it won't necessarily be any big directional bets. The third theme, of course, we can't talk about 2026 without mentioning AI. And going into 2026, we will expect businesses that has strong structural growth drivers, strong pricing power, and strong free cash flows to benefit from AI adoption, not hype. The hype is over. It's now coming down to really core adoption into making sure you're either getting efficiency, cost saving, delivering, better productivity. Also, the AI is starting to flow out into other key sectors, and healthcare will be one of those that is demanding it more and more. Not only because we're seeing more fragmented populations, but globally, especially in developed economies, we have aging populations, and overall cost of living is increasing everywhere because of the prolonged inflation. And combined with this aging population, healthcare systems around the world, but especially in developed economies, are really, really stretched. And so I'm looking quite closely at how the AI adoption will be really driving change in that sector going into 2026. And finally, that also links to digital infrastructure and data intensity. And really all this means is that as part of the AI adoption, balance sheets will matter more than late cycle hype. And finally, what I'm cautious about going into 2026 is I'm looking for balance sheets that are over levered, businesses that are relying on refinancing at lower rates. We've just seen that with JP Morgan bailing out one of their key creditors when they should have been Switzerland. And so too many businesses have waited out their time relying on interest rates to come down and thinking that they will refinance at a lower rate. That is something that I'm really cautious about for investing in any company, because I think it's a bit of a dirty trick. It's just a shortcut that companies shouldn't be taking. And then finally, I'll be also super cautious of pure momentum trades that don't have strong earning support. And that just links back to my last point about looking at how companies are trying to get to that earning support. And that means if liquidity tightens even slightly, these will be the first companies that suffer. And so that's why I'm really cautious of them. So going into 2026, the portfolio is positioned to stay invested in long-term winners. We are positioning it in order to absorb volatility without being forced to sell at any point. So we're keeping a healthy cash buffer, keeping healthy short-term bonds. And that means we'll really benefit from this compounding effect rather than playing a timing game. So more specifically, what this means inside the portfolio, as you know, we have exposure to AI and cloud leaders. So I still expect those AI demand signals, both like the GPU orders, cloud growth, to continue going up as we're seeing more AI adoption across the board. There'll be higher enterprise IT spending, and this will be somehow linked to the US dollar trending down. Thing I'm watching out for is commentary around NVIDIA supply. as we know, that's been heavily wrapped up in a lot more geopolitics than it should have been. For Microsoft, Amazon, Google specifically, we're looking at quarter-on-quarter cloud growth. For Meta, we're looking at AI infrastructure spend. And overall, if the market remains risk on, these sleeves will continue to outperform as they did in the second half of 2025, and I will continue to trim them down as the vertical moves. We also have our exposure to quality financials. So here we are looking at capital returns through buybacks and dividends. We have specific exposure to Goldman Sachs and JP Morgan, and also keeping a close eye on European banks and their payout guidance. And overall, if the interest rates continue to be stable and don't go down at the pace, we are prepared for a soft landing. The large gaps in the portfolio will be absolutely fine. We don't expect them to be affected by this curve, but we do expect some churn in some of the other sectors. And then finally, the defense and industrials. There's been a backlog of growth as government budgets have adjusted to domestic spending. And so we are keeping an eye on those order books, the contract wins, and specifically with Rolls-Royce, which is in the portfolio, the civil engine flying hours is a key parameter for us to look. But overall, taking a macro lens where the geopolitics really keeps the floor for demand here, and supply chain easing will just boost the margins. Another strong theme for us in the portfolio is around the digital infrastructure and data. So that means keeping an eye on data center demand. The pricing of this, as well as the power constraints, is really important. And that comes down to the bookings, the interconnectivity and growth, as well as churn that we're seeing in the industry. And these can be a bit rate sensitive because they often behave like REITs, but they also do benefit from declining yields. And then, as you know, I have also a bit of crypto exposure in the portfolio. I use it as a strategic hedge, and that just gives us some flexibility in terms of liquidity flows, funding rates, as well as network activity. And that will be the volumes which we saw, strong volumes at the end of 2025, is a sort of satellite proxy that we'll keep looking out for in 2026. So the way all this comes together going into 2026 for how this portfolio is run, the core principles is that I always do scenario planning. I never just predict one outcome. I have multiple scenario planning, which means we can quickly adjust depending on how things play out, and the portfolio is never sort of caught unaware. I will continue to have it as a net long portfolio, which aims to manage volatility, and I usually keep a healthy cash buffer and also opportunistic rebalancing. I very rarely, if ever, use leverage. I think I used it once many years ago. So I won't say I've never used it, but I haven't used it in many years now. And I don't intend to use it going into this year. That helps us manage the risk. And of course, our consistent and transparent communication. What that looks like in practice is we still expect periods of volatility, but our decisions, because we plan for multiple scenarios, will be driven by both deep data analysis as well as fundamentals. And that patience and discipline really remains our edge. And so I would like to thank so many of you who have trusted me with your capital, who have joined me on this journey. when I set out to create this portfolio, I only intended to, create my own financial freedom, but it's been an absolute privilege to take thousands and thousands of people with me on the journey through a platform like eToro, which does not pass on any of those management fees to the copier. And so a final reminder is my absolute golden rule for investing. You would hear me say it all the time. It's patience and discipline. Those are the two things that compound. Everything else is news. And what that looks like practically is I will keep rebalancing the portfolio, reinvesting any returns so copiers don't have to do anything. Many of you have asked about monthly deposits. That was something I used to do in the portfolio when I first started. I've reintroduced that at the end of 2025, and that would be a core discipline that we follow through 2026. If you would like to join us, any amount, any small amount, it's more about creating the act of discipline, taking the seriousness of paying yourself first. That's what it means for me. That's how I built this portfolio. I was very sad to suspend it because of copy logistics, but that's now been resolved. And so I'm delighted to reintroduce it because, as I said, it's my main investment portfolio. It's where I keep my money. And so it's great for me to be able to reintroduce a habit that is one of the core disciplines of my investment philosophy. And so with that, thank you very much for joining. Thank you very much for joining. I never keep a specific Q&A section at the end. I usually try and incorporate any questions throughout the presentation. But if you have any further questions, if you're a new copier or old copier thinking about copying, please drop them in the comment section. I always endeavor to keep up to date in terms of my communication, and I look forward to see you next quarter.